There is a collection of bills either stacked on your counter or silently draining from your bank account at this very moment. And some of those bills you are no longer legally obligated to pay in full. Not because something went wrong with the system, not because of some clever trick someone stumbled across online, but because the law itself created a protected class of people and quietly placed you inside it the moment you reached age 65. The problem is that nobody whose entire job revolves around collecting that money is going to drop you a congratulations card in the mail. The payments keep processing, the funds keep disappearing, and most people spend years, sometimes entire decades, overpaying on bills they haven't fully owed since before their most recent birthday. What I'm going to take you through today are 7 of those bills, one at a time, in straightforward language, with the specific action you need to take on each one. And I want you to stay with me all the way to the end, because the final 2 I'm going to show you are the ones almost no one ever brings up. And for the right person watching, they can be worth more than every other item on this list put together. Before we get into it, let me be clear about what this video is and what it absolutely is not. This is not a collection of clever tricks. It is not some murky gray area workaround. Every single thing I'm going to walk you through is a program, exemption, or legal provision that already exists within the system. It is already funded, already active, and already has your name attached to it in some capacity. The only thing standing between you and receiving it is a form, a phone call, or simply knowing the right question to ask. And I want to address 2 assumptions up front that tend to make people stop watching videos like this before they reach the valuable material. Some people hear the phrase financial relief for seniors and immediately assume it only applies to people facing extreme financial hardship. Others assume it only applies to people with significant wealth and complicated financial situations. Both groups are mistaken. For each of the 7 items today, I will tell you specifically who benefits most, so nobody watching can truthfully say that section does not apply to them. Let's get started. The majority of people over 65 are paying more in federal taxes than they actually owe, and it has nothing to do with filing dishonestly. It comes down to 2 separate deductions built specifically for people in their age group that are either being completely overlooked or never claimed at all. Here is how the tax code actually functions for someone who is 65 or older. Every American is entitled to a standard deduction, a chunk of income the IRS agrees to leave untaxed before it ever begins its calculations. For 2025, that figure is $15,000 for a single filer and $30,000 for a married couple filing together. But here is the piece that gets skipped over constantly. Once you turn 65, you become eligible for an additional deduction stacked directly on top of that base amount. For a single filer over 65, that is an extra $2,000. For a married couple where both spouses are 65 or older, it is $2,000 for each spouse, totaling $4,000 added on top of the standard. And then beginning with the 2025 tax year, Congress introduced an entirely new layer on top of all of that, an additional senior bonus deduction currently set at $6,000 per qualifying individual. So a married couple, both over 65, is now looking at the regular standard deduction plus the long-standing senior add-on plus this newly created bonus. Add those figures together, and you are looking at a very substantial portion of your income that the federal government has agreed should simply not be subject to taxation. Here is the trap, and it operates quietly. The people this helps most, the retiree living on a modest fixed income who files a simple return or hands everything to a preparer who is rushing through a busy season, are the exact people least likely to notice whether these deductions were actually applied, no alarm sounds, no notice arrives, the return gets signed, submitted, and the money goes out the door. The action here takes roughly 2 minutes. When your return is ready, before you put your signature on it, review it carefully and confirm that those deductions are present. If you use tax software, verify that your date of birth has been entered correctly. That is the trigger the system uses. And then ask whether your withholding from your pension or Social Security should be adjusted going forward, because a large number of people are essentially handing the government an interest-free loan year after year purely out of routine, and they treat it as completely normal. Please note that the $6,000 additional deduction phases out at $75,000 for single filers and $150,000 for married filers. Consult a qualified tax professional to confirm exactly what applies to your personal circumstances. Now, I mentioned at the beginning that there are 7 bills on this list. We have covered the first one, and already, depending on your individual situation, we may have just identified hundreds or even thousands of dollars that have been leaving your account without any real reason. But here is where things become genuinely interesting, because the next item on this list is where the largest single dollar opportunities are buried, and it comes in 3 separate layers that most people have never even heard of, let alone filed for. Most homeowners are carrying only one of them, if they have any at all. The first layer is the homestead exemption. Nearly every state offers it, and what it does is strip away a fixed portion of your home's assessed value before the county ever begins its tax calculation. In certain states, that figure is $25,000. In others, it reaches $50,000 or higher. The exact amount differs by location, but the core concept is identical everywhere. A lower assessed value produces a smaller bill, and here's where people get hurt. The homestead exemption is almost never applied automatically. It is a one-time form you submit to your county assessor's office. File it a single time, and in most states, it remains active for as long as you own the property. Never file it, and you pay the full unprotected rate year after year for absolutely no legal reason. The second layer sits directly on top of that one. It is called the senior exemption, and it is a completely separate application that becomes available the year you turn 65. Most counties that offer a homestead exemption also offer this one, and the county will almost never send you the paperwork on its own. You have to know to request it specifically by name. Here is what prevents many financially comfortable retirees from applying. They assume the phrase senior exemption signals an income test they will not pass. But in more than half the states that offer it, there is no income test at all. Age is the sole requirement. You turn 65, you file the paperwork, and you receive the benefit. The third layer is the one most people have genuinely never encountered. And for a homeowner sitting on property that is appreciated considerably, it is the most valuable of all 3. It is called the senior assessment freeze. When you apply for a freeze, the county locks your home's taxable value at whatever figure it holds in the year you file. From that point forward, it does not matter how dramatically your neighborhood appreciates. Your neighbor's assessed value might jump 40%. The market might surge. Your frozen figure stays exactly where it is. You are taxed based on what your home was worth the year you applied, not what it is worth today. For someone living in a paid-off home that has doubled or tripled in value over the past decade, that freeze carries enormous financial weight over time. Not within a single year, but across 5, 10, or 15 years of suppressed increases, the accumulated savings compound into a figure that can genuinely be staggering. And renters, please do not go anywhere, because this one touches you as well. Your landlord pays that property tax bill, and every dollar of increase that comes in gets pushed directly into your monthly rent. When property taxes are frozen or reduced across an entire community, pressure on rental prices eases. It is not immediate and it is not dramatic, but it is absolutely real. Your action step here is straightforward. Call your county assessor's office this week. Ask them directly whether the homestead exemption, the senior exemption, and the assessment freeze are currently on file for your property. If any one of those 3 is absent, ask what form is needed to add it and what the filing deadline is. That single phone call could turn out to be the highest dollar per minute conversation you have all year. That is the deceptive part about Medicare Part B. Because it is deducted automatically, a lot of people do not even register that they are paying it at all. They simply notice a smaller deposit arriving and keep moving. In 2026, that premium runs approximately $185 per month, pulled out automatically every single month without exception. But here is what almost nobody ever gets told. There is a family of programs called Medicare Savings Programs. And if your income falls below the qualifying threshold, your state will pay that Part B premium on your behalf, not reduce it. Cover it entirely. There are 3 different tiers. And the most comprehensive one does not stop at covering the premium. It also wipes out most of your deductibles and copays. Take a moment with that. Let it register fully. The income limits are considerably higher than most people expect. Many retirees see the word savings program and immediately conclude they earn too much to qualify, and a large number of those people are simply wrong. A significant number of states have also removed the asset test entirely, meaning the balance in your savings account or the value of your paid-off home does not count against your eligibility. Despite all of that, this program remains one of the most underclaimed benefits in the entire system. The action is one phone call. Reach out to your state health insurance assistance program, your local SHIP office. The call is free. They will screen your situation and walk you through the application process. That call, if you qualify, can return close to $200 each month directly to your Social Security deposit. Over a full calendar year, that adds up to nearly $2,400. And while you have that representative on the line, ask specifically about extra help. Some people know it as the low-income subsidy. It targets your Medicare Part D prescription drug costs, including your plan premium, your deductible, and your copays at the pharmacy counter. Here is the detail worth holding on to. In many cases, being approved for a Medicare Savings Program automatically enrolls you in extra help simultaneously. Two of the most significant health cost relief programs available, both unlocked by making a single phone call. Let's continue, because there are still 4 more bills left to cover, and several of these are going to catch you off guard. Bill number 4 involves your telephone or internet service. There is a federal program called Lifeline that reduces your monthly phone or broadband bill by approximately $9.25 per month for qualifying low-income households. It is not a life-altering sum on its own, but here's the frame I want you to use. This is a recurring bill the system has already determined certain people should not have to carry at full price, and it is sitting there unclaimed for the exact same reason as everything else on this list. You only receive it if you apply for it. Certain states layer an additional discount on top of the federal amount. And if you are a homeowner who qualifies, the Affordable Connectivity Program may offer further assistance as well. Stack several of these smaller items alongside the larger ones already covered, and your total monthly outflow begins shifting in a meaningful and tangible direction. Heating a home through winter and cooling it through summer. For many retirees living on fixed incomes, energy costs represent one of the most unpredictable and stress-inducing expenses in the entire budget. There is a federal program called LIHEAP, the Low Income Home Energy Assistance Program, that helps cover utility bills directly. Funding is distributed to individual states and then to qualifying households, and eligibility is based on income and household size. Contact your local community action agency or Department of Social Services to learn how the application process works in your specific area. This next item varies widely depending on your location, which is precisely why most people never hear about it. But in a meaningful number of states, once you reach age 65, your annual vehicle registration fees are reduced significantly or eliminated entirely. Certain counties offer comparable reductions on local licensing and permit fees. Some states provide free or deeply discounted access to state parks, museums, and recreational facilities for senior residents. None of these amounts are enormous on their own, but not a single one of them should be coming out of your pocket if the law says it does not have to. The action here is a single call to your State Department of Motor Vehicles and your county clerk's office, asking specifically what senior fee reductions are available and how to apply for each one. This next item is different in nature from the others, but it is every bit as important. A significant number of seniors are paying accountants or commercial tax preparers for basic returns that could be completed at absolutely no cost by IRS-certified volunteers. 2 programs exist specifically for this purpose. One is called Tax Counseling for the Elderly, or TCE. The other is AARP Tax Aid. Both are staffed entirely by trained IRS-certified volunteers. Both will sit down with you, prepare your return carefully, and file it at 0 cost. And critically, these volunteers know specifically which senior deductions to look for. They are not racing through a large volume of returns the way a paid preparer at a busy commercial firm tends to operate. If the expense of professional help has been part of why you have been delaying any of this, that excuse no longer exists. If you own your home outright and have accumulated some meaningful assets, there are 2 additional provisions worth understanding clearly, because for the right person, they can be worth more than everything else on this entire list combined. The first is property tax deferral. In a number of states, once you reach the qualifying age threshold, you can apply to suspend your property tax payments entirely for as long as you remain alive and living in the home. The unpaid balance accrues over time and is settled later when the home is eventually sold or transferred to your heirs. You protect your monthly cash flow now. Your heirs address the balance later. It is not the right decision for every situation, but for someone who is house rich and cash tight, it can fundamentally transform the texture of everyday financial life. The second is the surviving spouse exemption carryover. When one spouse passes away, the senior exemptions and the assessment freeze do not automatically transfer over to the surviving spouse. In many states, families lose those protections by accident, and the tax bill climbs sharply at precisely the worst possible moment. But if the correct paperwork is filed within the required time frame, the surviving spouse can frequently carry those protections forward without interruption. This is one of the most consistently overlooked provisions in estate planning for everyday families, and it is the kind of situation where understanding it in advance is worth an extraordinary amount compared to discovering you missed the window after the fact. Let me bring all of this back to a real person, because numbers only carry so much weight. I want you to picture a woman I will call Dorothy. She is 74 years old. She lives alone in a paid-off home she and her late husband purchased together decades ago. That home is now worth nearly 3 times what they originally paid for it. She gets by on Social Security and a modest pension. She has been filing her own tax returns for years. She considers herself fairly organized and on top of things. When someone finally sat Dorothy down and examined her complete situation carefully, here is what came to light. She was paying a Medicare Part B premium that her state would have covered entirely under a Medicare Savings Program she had never been told existed. She had no senior exemption or assessment freeze on record with her county, which meant she had been watching her property tax bill increase every single year, even as her income remained essentially flat, and her tax return had never once applied the age 65 additional deduction. So she had been overpaying the federal government year after year while receiving absolutely nothing in return for it. 3 separate gaps, each one completely invisible. No late notices arrived, no warning bells went off. Just money quietly leaving every month that never had to leave at all. 3 forms and a single phone call later, nothing about Dorothy's actual life had changed. She did not relocate. She did not sell any assets. She did not make a single major financial decision of any kind. The only thing that changed was the figure sitting at the bottom of her monthly bank statement. That is the entire point of everything I have walked you through today. Being legally entitled to something and actually receiving it are 2 completely separate realities. The space between them is not dishonesty or confusion. It is simply a form that has not been submitted yet. And nobody whose livelihood depends on collecting your money is going to hand you that form without being asked. So here is exactly what I want you to do this week, and none of it will cost you a single dollar. First, call your county assessor's office. Ask directly whether the homestead exemption, the senior exemption, and the senior assessment freeze are all currently on file for your property. If any of them are missing, request the form and confirm the deadline for filing it. Second, call your local SHIP office. Ask them to screen your eligibility for a Medicare Savings Program and for extra help with your prescription drug costs. 1 call and potentially 2 major benefits become available to you. Third, the next time your tax return is being prepared, before you sign your name to it, confirm that the standard senior deduction and any applicable bonus deductions for your age were actually included. Then ask whether your withholding should be adjusted so you stop prepaying the government unnecessarily. Fourth, research Lifeline, LIHEAP, and any state-level senior fee, waivers that apply in your specific location. These take a bit of searching, but the effort is worthwhile. And fifth, if the cost of professional tax preparation has been the reason you have not addressed any of this properly, look up TCE or AARP tax aid in your area. It is free, it is IRS-certified, and those volunteers know exactly what to look for on a senior return. A handful of phone calls and a small number of forms. That is the entire distance between where you currently stand and where your money actually belongs. One important note before we finish. Everything covered in this video is general educational information. It is not personal legal, tax, or financial advice tailored to your specific situation. The rules governing every one of these programs differ by state, by county, and sometimes by individual income and asset circumstances. Before acting on anything presented here, verify the details with your county assessor, your SHIP office, your state's tax authority, or a qualified professional you trust. And if something in this video helped you today, do one simple thing. Share it with one person you know who is 65 or older. It costs you nothing at all, and it might put real, meaningful money back into someone's pocket who has been quietly overpaying for years without ever knowing why. I will see you in the next one.